Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled that you're here. And I know you're going to get tremendous value from the gentleman we're interviewing today. Now, his name is Adam Finkel, and he's the co-founder of Tower Capital. And they are basically a commercial real estate structured finance firm. And they're in the capital markets. And so they broker all sorts of different types of loans for this exciting business that we're in, everything from agency debt to bridge debt to life insurance to we'll let him explain all the different vehicles that are available for financing multifamily. But anyway, let's get to it. Adam, welcome to the show, brother.
Great. Thanks, Rod. Happy to be here. Thank you for the introduction. My name's Adam Finkel. I'm the co-founder of a Scottsdale-based commercial real estate finance firm called Tower Capital, where we finance a myriad of different commercial real estate assets, multifamily being our bread and butter. And really under all different types of different situations. So whether it's someone buying a stabilized property or maybe they're refinancing, if someone's buying a transitional value add asset, we also finance ground up development, and that's here, in Arizona, throughout the, really throughout the United States, we're pretty active. I think we've closed deals in about 28 states so far. So since it's
very nice. Very nice. Well, welcome, buddy. So let's get into some things here. And before we get started, really, I want to talk over an overarching comment about dealing with brokers versus dealing directly with lenders. And so you're a broker, you're basically a mortgage broker as it relates to capital for commercial real estate. And I know you do other asset classes as well besides multifamily. We're going to focus on multifamily. But so guys, I'm going to tell you that I'm going to encourage you to utilize a broker versus going directly to a lender. And Adam, I'm going to let you explain why, because you'll do a better job than I will.
Sure. Thanks, Rod. Well, there's really many different reasons to use a broker. And even in my own life, for my own needs, I use brokers for things because they have the day-to-day expertise. The capital markets are always changing. Rates are changing. You have new lenders coming into the market. You have lenders exiting the market. You have lenders coming out with new programs or modifying programs or changing the leverage or changing how they are doing their underwriting stresses. And this is happening constantly every single day. It seems even, as time goes on, things change more rapidly. Not both in finance and life in general, I feel lately, but so really important to have, an active broker that is in constant contact with all of these different capital sources and, really having a pulse on what's happening today. Another reason for using a broker is just the surety of execution and making sure that things go smoothly and really maximizing your loan terms. I'm working with these different capital sources every day. I understand how they underwrite, what they like to see, what they don't like to see, what they're looking for in a borrower. And, we can massage the package and create the package in such a way to really accentuate what they're looking for and maximize, either if it's loan dollars or trying to get the best rate or whatever it may be. In addition to that, being able to create some competition in the marketplace and being able to send a deal out to a bevy of qualified lenders and create some competition in order to get, the borrower the best terms.
Yeah. And let me interject something. Let me interject something on that. So guys, if you go out there and present a deal to multiple lenders or multiple brokers for that matter, you're going to get a bad reputation because there's a lot of work that goes into evaluating a deal versus using a broker, like Adam and allowing him to present it. Would you expand on that, or do you agree or disagree with what I just said?
Yeah, absolutely. I mean, a lot of times I just kind of need someone to sit back and let me do my thing. I would definitely say, someone should be cautious of using, trying to use multiple brokers because the lenders are all very, very busy. especially nowadays. And when they see the deal coming in from multiple people, they say, okay, well, no one has control over this, and they're just not going to pick up the file, or they'll just put down the file. So, again, important to, pick a horse and go with them, someone that you're comfortable with. And, one of the things that's made us successful is, having credibility with the lenders. And when we bring one of our clients' deals to a lender, we're going to have a nice package put together. We're going to have all the information that they need. We're going to have a nice executive summary on the asset, on the area, on the borrower. We're going to have, all the supporting documentation. We're going to provide our own underwriting, the sales comps, the rent comps. And so, we're really putting that all together, and, the lenders appreciate that. And, so someone like myself, they're going to be looking at my deals, whereas maybe they might not be looking at other people where, maybe they think the person doesn't ever have control, or, they're just throwing something together. So, just having a really active broker, I think is important. Yeah.
Yeah. So let me ask you a question. When should someone engage you or get you involved? At what stage in a deal do you suggest being contacted and start a relationship? Well, in fact, that's two things. At one point, obviously you probably want to start a relationship first, get to know somebody, have them contact you and just spend a little time chatting with them. But at what point do you want them to bring you a deal?
Sure, absolutely. And that's a great question. Time is our friend. And, when people don't leave themselves enough time, that's when you can lose, negotiating leverage or just get stuck in a bad situation. So we always want people to be proactive and give us more time than less time. So what does that mean? Generally, for me, that means, you've already internally looked at the deal, you've underwritten the deal, and, you think it has legs. And then you send it over to me and you say, hey, Adam, I really like this deal. I like the location. We underwrote it. It looks good. We think we can hit the leverage that we need. Can you give it a glance over, and what do you think? Maybe the person's getting ready to put in an offer, or, maybe they could even be going back and forth on an LOI, and they think maybe they're getting close, and hey, we're getting close on this thing. Now, can you take a look at it? So, I'll say, great. Send me, the OM or whatever marketing, package there is on the property. Send me a trailing 12-month operating statement. Send me the rent roll. And those are kind of the three basic things that I need, to underwrite the deal, give it a quick underwriting, turn that around to 24 hours. And what I do is I underwrite the deal and I look at it and I see, what is the underwritten in place NOI? What do I think they're coming in at for leverage? And I'll have a conversation with the borrower and I'll say, hey, Mr. Borrower, the deal looks great. I'm hitting about, 75% LTV. It looks like you're buying it on an in-place, 6 cap, which is fantastic. And, I think, given your parameters of wanting a long-term non-recourse fixed rate loan, I think, we could go Fannie, we could go Freddie. Here's what the rates are looking like for, a 10-year fixed rate. And we can discuss some different structures. And then, they can continue to negotiate. They win the deal. Great. They pick a horse. I go out and get a formal term sheet or loan application for whatever that lender may be, and it's off to the races.
Nice. Yeah. So yeah, I know that in your house you do, like I said, you do conforming debt. You probably I assume you do CMBS when it's around. You do life insurance. You do all the above. But also you also place bridge debt as well. Is that correct?
Yes.
Right.
Yeah, we do a lot of bridge loans.
Right. So let's talk about that for a minute. Now, guys, those of you that are brand new, to get conforming debt, you need to be 90% physically occupied for 90 days, 90 for 90. Remember that. But if you have a property that's not at that place, then you're likely going to need bridge debt and to do your value add play and then ultimately refinance into hopefully some agency debt. So, as it relates to bridge debt, can you talk about some of the different scenarios you're seeing right now, terms, situations, just expand on this, just take it wherever you want to take it as it relates to bridge debt.
Sure, absolutely. Well, there are a lot of options for bridge debt right now. And really it can range from, your local hard money lender to more of these, larger debt funds that can be backed by, private equity groups, or, they can even be backed by life companies in all different places, or you have, the traditional lenders such as, the banks that maybe they have some kind of, bridge program. Typically that's going to be a recourse loan versus a non-recourse loan with the debt funds. Really when I'm looking at a property and we're looking at a bridge situation, there's a couple of different variables that are going to direct what type of bridge lender. First is, how large is the loan? A lot of these debt funds, they don't want to write a check that's less than 10 million or $15 million. And the larger, more institutional ones, some of them, they don't want to write a check under $50 million. Obviously those are going to be the lowest priced, the cheapest money is, the larger deals, the larger, debt funds. Then you have, at the other end of the spectrum, if you're dealing with a smaller property and maybe you're only talking like a $3 or $4 or $5 million loan, sometimes it's easier to go to the local private money person where, they're charging high single digits and a couple of points, but, they'll close in 2 weeks. They're not ordering all the third-party reports. You don't have a big lender legal bill, that you're going to get hit with. So, that's really the thing is sometimes people can, be attracted to, these debt funds and they hear the money's really cheap. But then, for certain situations, it really doesn't, it doesn't really add up. You don't have the economies of scale, with all of the fees and some other things that, come into that. So, just really understanding, what's the size of the deal? And then also, how heavy of a bridge is it? Is there any cash flow that's in place? Maybe there's cash flow and it can cover a 1.0 debt service, but it just has 20% vacancy instead of 10% vacancy. Or is it a property that maybe you're converting it from a hotel or a student housing to a multifamily, and it's going to be completely emptied out, and maybe like some of the mechanical systems need to be adjusted. I mean, that's going to be a very heavy bridge where, you're going to need a certain type of lender that's comfortable with, an empty building for a certain amount of time. And in those cases, they're building in interest reserves, into the loan that will cover the debt service during that period where there's no cash flow. And those lenders are going to typically be a little bit higher price lenders than, a very light value add bridge where there is some cash flow. And maybe you could even go to a bank and get a bank to do it, for, a very low rate. So, just really just depending on the situation, you're just trying to match that up with the group that's going to be the best fit.
And I've heard this expression around bridge lending, and that is it can be a little bit of the wild, wild west. And there are some unscrupulous players in that arena as well. And I have an example with one of my students that had a commitment letter from a bridge lender that bailed a day before closing, and they ended up buying the asset. The bridge lender did. Now he can't speak to the exact deal, but I would you agree that you definitely want to work with somebody that has had experience with a particular bridge lender, knows how they operate, knows that they're for real, knows that that they deliver on what they promise. I mean, do you want to speak to that at all?
That's really great insight. And really, no matter what type of lender you're working with, you want to, make sure that they're qualified, they're active, they're doing those types of deals. Who have they lent to before? What was the experience? Because, you can have, the local shady private money guy, that is, doing, bad things, or you can just have a bank that they're so darn slow and their process is terrible, and they're issuing a term sheet and the credit person hasn't looked at it, and they drag you out for 3 months, and then the credit guy says, I don't like the deal, and then they're knocking $500,000 off your loan. That's a bad experience too. Right. So really just another reason to be utilizing an active broker where, they know what lenders are good, who is executing. We're part of although I'm an independent shop, I'm part of a national group of independent commercial mortgage bankers and brokers like myself, where we do information sharing and we get on a call every 2 weeks and we have a new lender. And, if someone's dealing with a lender that they haven't heard of, they shoot an email out to the group. Hey, has anyone heard of this lender? Has anyone dealt with these guys? What was the experience? So yeah, I mean, look, it's, and even, in my own business, when I'm taking a client to a lender that I've never worked with, I always have some hesitation, and I really try to get a good understanding of what is their process, what's their approval process, who has looked at the deal so far, what other information are you going to need, what's your timeline, and really try to make sure we get a full understanding of all those things.
Well, that's really good. That's great. So can you talk about what's happening right now in the capital markets? What, pricing, things like that? Just what are you seeing right now? And, where we're fourth quarter, things normally slow down this time of year. Maybe you could speak to that as well. The seasonal aspect of the capital markets as well.
Sure. And I think that, most of the lenders have been running pretty hard this year. Everyone kind of took their foot off the gas and took a step back last year, in the heat of COVID. Now with things coming back, money has to be placed. And obviously there's certain markets in the country that, the lenders and the equity groups are gravitating towards. Typically those are going to be, kind of like the warm weather smile states, they call them, are still being very attractive. Really a lot of the markets that are seeing, influx of population growth, sure. Texas, Florida, Arizona, Denver, Salt Lake, Carolinas, the lenders, they like those deals. If you've got, a multifamily project in any one of those markets, they're hungry for that. Obviously, there's a big lack of supply of multifamily housing in a lot of these markets. So right. The lenders want to be putting money out in that asset class. I know we're focused on multifamily, but just real quick, the other big asset class that the lenders are looking to put money in is industrial as well. Kind of an undersupply there. So kind of those two asset classes very popular. The rates obviously are remain at all-time lows, both for long-term debt, and short-term debt. The bridge lenders are very aggressive and, very hungry to try to get deals. While at the same time, due to all of the transactional velocity and the volume, we are starting to see, some of the spreads widening. Some of the lenders are becoming more selective, with the deals that they're doing and everything. So we are starting to see a little bit of a pullback, although it's, still compared to, past years, it's the pricing and the terms are very, very attractive right now, for borrowers. For bridge loans for shorter term debt, 75 to 80% of project cost, that would typically include your purchase price plus cost of any capital improvements. Some lenders will allow you to include, developer fees or, certain, fees in there. Some will want to net that out. Some of the lenders, we're even getting up to 85% loan to cost. Some of them will say, we'll finance 80% of the purchase price and 100% of the CapEx. You're seeing, some of the lenders offering these stretch senior loans again, where they're basically holding an internal A note and B note to provide higher leverage at a blended rate. So, the lenders are very aggressive again. On the conventional side, with the agencies and then even the banks to some degree, they were holding back a lot of reserves, extra reserves from COVID. That has, right. gone away. Fannie isn't doing it anymore. I think Freddie in certain situations may have, some COVID reserves. The banks, I'm not seeing COVID reserves from the banks anymore. So, the lending environment has certainly loosened back up in that regard, while at the same time, the lenders are maintaining their underwriting requirements. So they're still wanting to see a minimum debt service coverage ratio or a debt yield. So they're still very focused on that. But
let me interrupt you. Let me interrupt you for 1 second. Just so you guys, some of my listeners are brand new, and that debt service coverage ratio is the property's ability to service the debt. And he mentioned that earlier when he said some bridge lenders, might want to see a 1.0 debt service coverage ratio. And that just means it's an annualized number based on the property's ability to service the debt. So you take the net income, you compare it to the annual debt service. If you've got $100,000 in net income and $100,000 in debt service for the year, that's a 1.0. Most lenders want to see a 1.25 debt service coverage ratio. So they want to see $125,000 in net income or even a little more depending upon markets. Correct me if I'm wrong on this, Adam, but 125 is typically the minimum for agency debt unless it's in an area that they consider, I forgot what the term is. What's
primary market?
Yeah, they want that, if it's not a primary market, but that, that's you said something else that I wanted to expand on. Yeah, I forgot.
Well, yeah, but the debt service coverage ratio is very important. So the lenders want to make sure that, after the debt service has been paid, that there's some cushion there for, unexpected things or whatever. Maybe you lose some extra tenants and they want to make sure that there's some cushion. So that's why generally they're going to want, a 1.25 debt cover, 125%, cash flow compared to the debt service. Typically, if they're going to be lowering the leverage, the agencies, Fannie and Freddie, they go on a tiered system. So basically, they call it tier 2 is full leverage at 75 or 80% LTV. That will be a 1.25 debt cover. The next tier 3, is going to be at 65% LTV. And that will require a 1.35 debt cover. So they want to see a little bit more debt cover at the lower leverage, but you're also getting, more attractive pricing and maybe some additional years of interest only and so forth. Then they have tier 4, which is 55% LTV. They're going to want a 1.55 debt service coverage there.
Interesting. Okay, I didn't know that. It's very uncommon to see that kind of, loan to value, unless probably big players that get into the arena that have lots of liquidity. But fascinating. Yeah. So just trying to think if there's any other thing I want to ask you about. But guys, check. What's your website, Adam?
Sure. My website's www.towercapllc.com.
Gotcha. All right. Well, listen, I really appreciate you being on the show. And, this is a topic that even for me sometimes is a little overwhelming because there's so many little nuances and details to it. But I was mentioning to you, we just closed on our San Antonio asset here a few days ago. And we got like 3.2 interest rate, 5 years IO, and just an incredible. I mean, I remember, I'm old, I'm 61. I remember when 7% was like a home run for interest rate. And now we're, at 3.2. It's just unbelievable how awesome the rates are right now. And by the way, guys, I don't know when this episode will air, but I think we actually still have a few slots left in that screaming deal. It actually breaks even day one at 40 right now. It breaks even at 41% vacant, economically vacant, which is very unusual in this market. And most of the deals that are being done right now by operators are 70-30 splits or 80-20 splits, and we're at a 50-50, and we still have a 10 to 12% cash on cash, 15 plus IRR on this deal, just because it's such an incredible deal. So if you're interested, text the word partner to 72345. And even if that one has fully subscribed, we're doing some post-closing subscription just because Scott, my partner, and I have been so busy with live events and stuff. But if you text partner to 72345, we can let you know about the next one if that one's fully subscribed. But anyway, Adam, I appreciate you coming on the show, my friend. You've added a lot of value, and I'm sure that we'll stay in touch now that we know each other and talk soon.
Perfect, Rod. Well, hey, thank you very much. Have a great weekend, and I appreciate the opportunity.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345, and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.